When it comes to an efficient strategy, knowing when not to trade is equally as important as knowing when to trade. If you're trading to make profits, you want to remember minimizing losses is literally the same as maximizing profits. Or if a strategy wins big but simultaneously loses big, it is meaningless. Moreover, developing and focusing on this dynamic of your strategy in the early stages will dramatically shorten the span of time needed to develop a profitable strategy, because it sheds years off of backtesting that particular situation when you intentionally do not trade. So again, when developing a strategy, it is crucial to contemplate when not to trade and implement this dynamic into your trading strategy. And that said, knowing when not to trade is not a one-size-fits-all concept. When not to trade is only efficient, thus worthwhile if it is compatible to your trading strategy. So today, let's look into how a trader can locate these points in time when not to trade, and further, how to implement it into your trading. To begin with, let us contemplate what it even means to develop a strategy. If you think about developing a strategy, it's basically an endless journey of problem solving. Every time a strategy fails, you figure out why and find a solution which equates to evolving your strategy. Now, what needs to be evolved can be any one of the elements of your strategy. It could be the bias identifier, entry strategy, stop loss and target strategy, or trade management. Now, the knowing when not to trade factor of a trading strategy will fall into trade management, in my opinion. Now let's go and look at some examples of these elements. Okay, so the first element of a strategy is the bias identifier. So the bias identifier essentially tells the trader which direction he or she should be trading in. So let me show you a real life example. If you watch my forecast and analysis, you'll know on this Euro-USD weekly chart, in this entire area right here, my bias identifier stated that the bias is short. So in other words, my bias identifier stated that I should be looking for short entries in this entire area. And so if you recall, that is why I took two short entries, one at this 1.2150 level right here, and another one at this 1.2030 levels right here. And again, that was because my bias identifier stated that the bias was short, and thus I should be looking for short entries. Okay? And then we have the entry strategy. So an entry strategy is a systematic method that allows you to enter a trade in the direction that the bias identifier dictates. So for this example, let's go to the daily chart. All right, so again, on this daily chart, that bias identifier that I showed you previous stated that in this entire area, the bias was short. So one example of a systematic method that allows you to enter a trade in the direction that the bias identifier dictates is as follows. So in my case, I will look for pivots in which there is more short strength than long strength, where I'm looking for short entries along with the short bias. Now, if you don't understand what I'm talking about in terms of short strength and long strength, please watch my price action trading course, and that should clear things up for you. And so if I find two pivots in which there is more short strength than long strength on that first red candle, which would be right here in this case, I would take the short entry. And again, this is one of my systematic methods which allows me to enter a trade in the direction that the bias identifier dictates. Okay? And now let's go on to the stop loss and target strategy. Now the stop loss and target strategy essentially provides a static risk and reward parameter. So going back to that previous entry example, I will enter a short trade at the close of this red candle right here, which is along with the short bias, and the stop loss and target parameters will be, first of all, the stop loss will be at the pivot high of where I measure that short strength, and the main target is at the pivot low of where the long strength was measured. So this gives me a static risk and reward parameter, with the risk being from my entry point to the stop loss point, and my reward being from the entry point to the main target point. Okay, so let's go back to the weekly chart. Alright, so we're back on this Euro USD weekly chart. Now the final element of a strategy is trade management. Now trade management includes many dynamics of trading, but at its most gross level, trade management in fact dictates how a trader manages his or her trade. So again, on this Euro USD weekly chart, if you watch my forecast and analysis, in this entire area, I was short biased, and therefore I took one short entry at 1.2150 right here, and another one at 1.2030 at this level right here, with both stop loss points at this point right here, and both main targets at this pivot low right here. Now, as price was falling down toward my target, constantly I was applying trade management rules as price fell down to my target level. And therefore, at this point right here, if you recall, I took out 90% of both positions before the main target was reached, and moreover currently am holding another 10% of both positions to see if it could get any further. Now the decision to take out 90% at this point right here, and moreover the decision to extend 10% of both positions, both are derived from my trade management strategy. Okay, so again, at the most gross level, trade management refers to how you manage a trade. However, there are other dynamics that also fall into trade management. Now, one of those dynamics is knowing when not to trade, which is the topic of this lesson. Now, let me show you a real-life example of a situation where I intentionally do not trade. Okay, so again, like I showed you, I took an entry at 1.2150 right here, and another one at this 1.2030 levels right here, with both stop losses at this pivot high, and their main targets being at this pivot low. Now, if you recall, at these points right here, there was a nice pullback that came all the way up to these levels, which enticed me to take another short entry. However, I did not take this short entry. And if you recall, it was because this pullback was based on an NFP release catalyst. So one situation I do not trade are pullback entries that are based on NFP catalyst, and therefore I did not take this short entry and waited for another pullback at this 1.2030 levels for that second short entry. Okay, so I'll get into more detail about this NFP pullback situation in which I do not trade, but for now let's go and see how one will go about finding these situations when you intentionally do not trade for their own strategy. So a trader builds the foundation of each element of a strategy. Then every time a strategy fails, the trader figures out which element of their strategy is responsible for the failure, then adjusts and hones that element until the strategy as a whole becomes efficient enough to consistently earn profits in the long run. However, realistically, there are going to be times when you just can't figure out why your strategy failed. No matter how hard you look for the element in your strategy that caused the failure, you can't seem to find it. So in other words, the reason for the failure is unknown. And therefore, I refer to these episodes when you can't figure out the reason for a failure of a trade as unknown failures. So the first sign in which a given market environment may qualify to be a situation where you intentionally do not trade is when you just can't figure out why a trade failed. Now let me show you an example of this. Okay, so on this pound dollar weekly chart, in this entire area right here, my bias identifier stated that I should be short biased, and thus I was looking for short entry setups on the lower time frames, and one formed on the daily chart in this area. So let's go over there. Okay, so on this daily chart, that short entry setup was as follows. So between this pivot right here and this pivot right here, there was more short strength than long strength, and thus on the close of this red candle right here, that short entry setup was confirmed at this level right here. And then moreover, my stop loss and target strategy stated that my stop loss should be at the pivot high, where I measure the short strength, and the main target at the pivot low, where I measure the long strength. However, as you can see, for about 2 weeks, price just ranged about. And at this point right here, the NFP report was released, and price wildly came up and stopped out this short trade at the stop loss level at this pivot high. Now, for years, I've encountered this situation where each element of my strategy was still pointing price down to its main target right here. However, when the NFP was released, there were times when price irrationally just came up to stop out those short trades. And no matter how much I tried to figure out which element of my strategy was responsible for this failure, I could never figure it out. However, now that I labeled the NFP announcement as a situation in which I intentionally do not trade, let me show you how I actually traded this setup. Okay, so that short entry signal formed at this level right here at the close of this red candle. Moreover, the stop loss was at this pivot high, and the main target was right here. Now, first of all, if you recall, I did not take this short entry immediately, for the risk and reward was not that great. However, the following week, as price pulled back to these levels right here, since my risk was minimized at this point, I took a short entry roughly at these levels right here. And moreover, as price ranged about the following week, if you recall, I aborted the entire short trade on the day before the NFP release, which is right here, roughly at these levels right here. And surely enough, the following day on that NFP release right here, price wildly came back to stop out that short entry. Alright, so now let me explain to you why I decided to label the NFP announcement as a situation in which I intentionally do not trade. Now, the core reason why I decided not to trade situations where the NFP announcement is the catalyst for price movement is simple. It is because for me, analyzing and devising a solution that can incorporate the NFP within my strategy is just too difficult and time consuming. But of course, in my early years of trading, I did confront the failures of my trades with NFP releases. But after years of trying to figure it out, I noticed that with my expertise, being a price action trader, it is more simple to just label this market situation as unknown and thus not trade it. Now, if I was a fundamental trader, then the failure of a strategy with the NFP will perhaps be solvable. So the key to knowing when to label a market situation as unknown is to ask yourself, with your strategy and the given market situation, as well as your expertise, can you figure out the reason for a trade's failure in a reasonable amount of time? If not, the great thing is that you can always come back to solving this issue after you gain more experience, and in the meantime, still be able to trade with minimized losses. Now let me show you my personal unknown trades list, and moreover, explain the reasons why I put them in the list to begin with. Okay, so the first situation that's in my unknown trades list is I do not take huge pullback entries after that trade has already gone a significant distance. So let me just explain what this is about. So on this Aussie NZD weekly chart, in this entire area right here, my bias identifier was telling me I should be long biased. So in all these areas right here, I was looking for long entries on the lower time frames. And there was an entry that formed at this level right here on the daily chart. So let's go over there. Okay, so on this daily chart, that long entry formed on this candle right here. And in this case, my stop loss level was at this pivot low right here, and the main target at this pivot high way up here. Now, as price came up to these levels, before the main target was reached, price gave a huge pullback. Now, at this point right here, it was very enticing for me to take another long entry, for the risk at this point was minimal. However, due to the fact that this situation, where there's a huge pullback after price already ran a significant distance, is in my unknown trades list, I did not take this entry And as you can see, that saved me from a losing trade for price burst right past my stop loss level right here. Now the reason why this situation is in my list is twofold. Now number one, knowing the characteristics of my strategy after entry forms, if price moves a significant distance, it is extremely rare for price to pull all the way back to give me another entry opportunity. And odds are that I misanalyzed the target aspect of my trade setup. So in this case, initially, my main target was at this pivot high right here, but there was actually a strong level at this level that provided as a target for this long entry. And since this trade's target was already hit, price pulled right back down to stop out the long traders that are still in this long trade at this stop loss level right here. And now the second reason is because I'm a manual trader in which I personally analyze the charts daily, it is inevitable that I will make analysis mistakes from time to time, like this misanalysis I made with targets in this case. Okay, so those are the main reasons why I do not take situations in which there's a huge pullback for entry after a trade already won a significant move. Okay, and moreover, like I mentioned earlier, I also do not trade situations where the NFP announcement is the catalyst of price movement. So let me show you this example on the Euro-USD chart. Okay, so on this Euro-USD chart, in this entire area, my bias identifier told me I should be short biased, and thus I was looking for short entries in all these areas. Now one setup I have on the lower time frames to enter with this higher time frame short bias are through price patterns. Now in this area right here, there was a price pattern setup that I could have taken for a short entry. However, I did not take this short trade because the NFP announcement was released at the exact same time. Now let me explain this in more detail. Let's go over to the 5-minute chart. Okay, so on this 5-minute chart, there was a fake double bottom that formed right here, which is a trade setup I could take with a higher time frame short bias. Now how I would trade this setup is that the stop loss will be at the target height level, which is roughly in this area right here, and the main target will be at the second bottom level right here. Now moreover, the NFP was released on this candle right here, right when that second bottom formed. And what happened on the 1-minute chart was price erratically came up to stop out the stop loss level right here, then came down and came right back up, and then kept going up for the following week. Now because I did not trade situations where the NFP is a catalyst for price movement, that rule again saved me from a losing trade. Now there's two reasons why this situation is in my unknown trades list. Now first of all, it's because the NFP is only released once a month. Now if the NFP was released every week, then that would interfere with my daily trading, and thus I'll have to figure out the reason for its failure. However, in reality, since the NFP is only released once a month, I'm okay with missing out on trades if it's only once a month. And the second reason is, like I mentioned earlier, is because I'm a price action trader. Now don't get me wrong, I did try to figure out the reason for the failures of trades with NFP announcements in the past. However, I could not figure it out through price action. Now if I was a fundamental trader, then perhaps the reason for the failure was solvable. However, in reality, since I'm a price action trader, figuring out the reasons for failures of trades on NFP announcements is simply not worth the time, considering the NFP release is only once a month. Now, if you're unsure about whether or not you should develop an unknown trades list, just remember, trading is a long-term endeavor. It takes time to develop a winning strategy. And when it comes to strategies, they can never be perfected, simply for the reason that the markets are always evolving. Thus, there will always be another failure that you, as the creator of the strategy, must solve. That said, it doesn't mean you can't be profitable in the meantime. But the only way to be profitable while you are developing your strategy is to minimize losses through the implementation of unknown trades into your strategy. Okay, that's it for this lesson. Let me know if you guys have any questions. Okay, bye.